correct. And I mean, to think of it, that horrors from Sunday seem to be quite the bad memory now. So we seem to have come off of that much stronger. And to think of it, it was only day before. 4.25% higher. Adani Enterprises, Adani Green, Wari Energy, CG Power, SRF, all up 10%. I can't spot a single red tick within the F&O pool right now. All stocks are holding out in the green as we speak. But let's welcome on board then Sanjay Mookim, Head of India Equity Research at JP Morgan, and find out what he's making of life after the India-US trade deal. Sanjay, hi, good morning. Great to be speaking with you. Sanjay, you think the horrors of Sunday are now behind us when the market was in panic mode, reacted to that STT hike? I mean, look where we've come in just a day and a half.
Well, I think it's all a lesson for us. Markets do react emotionally all the time to things. But I would argue that the resolution on the trade deal is a good outcome for the overall economy. And more so, look, because our industry is now competitive with the 18% tariff. We are at or below peers in Asia or South Asia. And this should provide enough of a fillip to our manufacturing industries, the ones that were tariffed for a while. And I think the market's reaction is very logical in response to the potential for Indian economy, for the Indian manufacturing sector to benefit from this deal.
But Sanjay, is this that big re-rating moment which will turn the tide on those $22 billion of FI outflows?
So let's break it into two parts, right? One, of course, was the crisis of confidence that we were having in the markets, right? The economy was doing fine. Exports were actually holding up better than we had feared initially when the tariffs were originally imposed. But at least there was this crisis of confidence. There was outflow of foreign money. Balance of payments was negative, and we've seen the impact, on the INR as well. And hopefully, what's happened overnight addresses that confidence issue for one. But what we have to now track, and hopefully these things will improve, is the sort of trade balances we run, the sort of capital inflows that the country is able to attract. And if those settle down and the pressure on outflows reduces, then of course this will turn out to be very structural. Because the other thing that I'd probably argue is that while the tariffs were very high to begin with, they didn't really have a very material negative impact on the earnings trajectory of the large cap stocks in India. So it's not necessary that when the tariffs are resolved as they are, I'll get a major upgrade cycle coming through in the market. That needs to be far more organically driven.
Sanjay, if you look at for export sectors, while the tariff has come at 18%, much lower than the 50% which they have been imposing, the recent depreciation of rupee is also helping. So the net impact for many of them would be much lower than 18% in that sense.
Yes, the trade-weighted rear has come off quite a bit, let's say from 105 to 95. The rupee, you can argue very clearly, is undervalued at the moment. And a lot of that was necessary because of the tariff uncertainty. You wanted exporters to be competitive. Local inflation was low enough for us to permit that without having too much of a local problem on the currency depreciation. I think so all of this will fall in place. You have a more competitive currency, you have a competitive tariff rate as well. So if I were an exporter and looking to grow my export business, I'd be fairly excited right now.
And do you see rupee going back to 88, 87 levels or maybe even to 85 now that you have that uncertainty away?
I think that might perhaps be a bit too much to ask for. And in fact, as a policymaker, maybe that is not an advisable outcome to begin with, right? And if you start to see inflows coming in, it may be advisable for the central bank, for example, to absorb those inflows and build reserves rather than to allow the rupee to appreciate materially.
Sanjay, as an investor, I think the question is, do you recalibrate your strategy? Because the last year and a half, you were looking inwards, you were looking at domestic-facing sectors. With all the policy measures that the government took outside of the budget, you could see that reflective in the way, consumption began to pick up in pockets. But do you go back to the unloved and completely ignored export-facing sectors at all in terms of portfolio building?
I think the challenge there is that the large cap exporters were already out of the tariff, right? So my IT and my pharma stocks, which are my heavyweight exporters, they were not tariffed to begin with, and they don't have the net benefit from the overnight developments. If I have to then talk about the exporters, I need to go to the much smaller cap stocks in India. And the challenge will be how much can you allocate? If I'm a fund manager, how much of an additional delta I can allocate to the exporters who have benefited from the reduction in tariffs. It will not be too much. But if I take a step back and debate the question between large cap and small cap outcomes in India, I think that needs to be anchored more again to earnings delivery and earnings surprises. And in my sort of suggestion is that with the overall economic momentum, nominal GDP still somewhere around 9 to 10%, the breadth of earnings growth in India is still going to be narrower than it was 2 years ago. And therefore, even though I have, let's say, more confidence in, let's say, hopefully flows or multiples in India, I would still argue that a large cap strategy will make better sense than a small cap one or mid cap one at the moment.
You know, I was going to come to that point about earnings because I'm sure this exuberance of fear, as it always is the case, will settle down in a couple of days. While earnings have been better than what we did in the previous quarter, sporadically you are seeing very impressive earnings as well in some of the consumption-facing sectors. But when do you hope for a more broad-based recovery, Sanjay?
Well, that is something that we are a little nervous about, to be honest. And look, this is the issue of composition, right? And like I was saying, if the overall economy is going to grow 9 or 10% in nominal terms, then I cannot expect that the median growth of 1,000 stocks in India is going to be 15%. Right? It will have to be anchored to the overall aggregate nominal activity in the country. So you'll have a smaller set of companies that deliver double-digit growth. And the median companies in India will probably be in the low double digits or single digits even. So to expect what we saw in FY23, where everything was growing 20% and we extrapolated to all kinds of themes in India, that is not going to happen for quite a while, to my mind.
Sanjay, you spoke briefly about the earnings and how the tariff may not have impacted the large caps there, but overall for the entire universe, do you think that uncertainty has moved out and that would also allow them to look at export markets in the US? Because we had one of the speakers talking about the fact that the India-EU trade was creating a FOMO or fear of missing out for the US, because there was an import substitution that could now happen from the European Union as compared to the US, and that forced them to come into the deal. Do you think that is one of the arguments that could be made, and what could be the impact on overall earnings or trajectory over the medium term period?
Okay, look, I don't want to dismiss the positives of these trade deals, right? Both of them. The EU-India trade deal can be very material over a medium term. The sort of access that we've got to a large consumer set in Europe is very, very material, right? And again, I'd highlight that it is not just the absolute level of tariff, but your relative tariff. So even though we are now paying 18% still on most goods to the US, it's lower than alternative manufacturing areas, the ones that we compete with. So if these arrangements stay for the next 5 years, I think there is a material advantage that the Indian economy will gain. Many Indian companies will earn that advantage over the next 5 to 6 years. So this is a very useful outcome. We should all be very positive about it. The only challenge is how you express that in stocks in the listed universe. And as I was arguing earlier, that there are not that many large cap stocks which will have a material delta. You'll need to go down to some of the specific mid cap sectors, the obvious ones, the textiles, the leather goods, etc., that will benefit and will have that multi-year tailwind to drive earnings up.
So give me a sectoral allocation, Sanjay. What's top on the list of outperforms, and what would you avoid in this market?
Well, staying with the large caps, of course, we like the financials. Financials are a great macro reflection of the economy. We are also seeing bottom-up benefits from the increasing liquidity, from the bottoming of the, let's say, rate cycle. Hopefully, the NIMs don't come under pressure again. And we would argue that the large cap banks at very comfortable valuation will deliver 14% EPS CAGR over the next 3 years. So just a buy-hold strategy on the financials should continue to work, and returns should be very reasonable. We think that there is momentum on the consumer side as well. You are seeing in certain pockets, let's say particularly the autos, the impact of the tax cuts and the stimulus has been real, and we expect some of that to sustain. And this, we can't talk bottom up on this platform here, but I would argue that certain consumer categories or consumer discretionary categories should continue to deliver earnings momentum.
Sanjay, hi, this is Harsh. You've given a target in September of a 6 to 12 month Nifty target of 26,500. Do these trade deals give cushion to the rupee, thereby inviting FIIs? You speak with FIIs as well, and thereby likely raising that target that you have with regard to the Nifty.
Okay, so let me update that. Our target for this year end is about 30,000 now. And so that's fairly optimistic, to be honest. And I would argue that, look, it does solve the confidence problem. You were into a little bit of a negative circularity, if you will, where people were worried about the currency and that was probably holding flows back, etc. But one of the other challenges that we face currently is the relative argument. Right? There is greater excitement in certain other markets in the region where you have huge tech cycles, where the memory cycle is doing extremely well. And in context, India is now a slightly better placed market, given the developments of the last few hours. But if I were a long-only investor, I still have more attraction currently to look at large cap, technology-driven North Asian sectors than perhaps to spend money in India. So it's better, but I don't think it is a complete solution, at least in the very near term.
Sanjay, specifically on IT, I wonder whether you have a view with regard to the turnaround there, because we waited for it for very long. Commentary even now doesn't look positive. How do you look at IT in particular?
Well, I would argue that the turnaround is perhaps being a little optimistic. I think it's come in better than people had feared. So that, of course, is very good for us. Everybody was very nervous that Indian IT companies may feel pressure from AI and the slowing US economy eventually. None of that has happened, which is good for us. But those risks remain, right? You can't resolve that uncertainty now. AI could still have a negative impact on companies. And of course, the bigger issue of an eventual slowdown in US activity is still a problem. So in the context of what we can see happening in financials, IT perhaps will come lower down the pecking order.
Okay, Sanjay, such a pleasure speaking with you. Thank you for your time today.
Great to be on. Thank you.